I passed course 4 with a 92%, and if you want to pass, you need to know these 5 things. Now we're going to go through 3 types of loans and 2 types of math questions. Now typically these 2 math questions come up typically on almost every single exam, so you're going to want to make sure you stick till the end of the video to maximize your scores. Now the first loan we're going to look at is called the bridge loan. Now the bridge loan is a loan used when I want to close one sale before I receive funds from another sale. Meaning, for example, I want to sell my current property, take the profits from that sale, and then use those to buy a new property, right? That's what most people do. They sell the current house, they use those profits to buy the new one. However, what if, depending on the market, you're not able to sell your current property, but you still want to buy the other one in time, right? Because obviously competition. So what you do is you get a bridge loan to bridge that gap between both of those sales. So what this does is maybe my house is going to take another 2 months to sell, but I can get a loan, a bridge loan, where I can get the funding to buy the new property I want. And then finally, within a month or 2, when I'm able to sell my current property, right, or my old property, I can then sell that property, take that money, take the profits, and repay that bridge loan. So really, this is a loan that we're using to just bridge that gap between me selling my old house and me buying a new one. So typically in a perfect world, it's totally okay, right? You want to sell a current property, you get the money, and then you buy the new one, and it's all in order. However, that doesn't always happen in real life, and sometimes you might have to close a new property before you even sell your current one or your old one. And that's where the bridge loan can come into play. Now keep in mind, for those of you guys that are still confused with the development loans, stuff like the developer loan, the gap loan, and the standby loan, I've already done another video on that, and so I will put the link over here or check the comments below. I go through all 3 of those and I make it really, really simple to understand. Okay, the next loan is called a blanket mortgage. Now the blanket mortgage is fairly simple. It is a single loan that covers 2 or more properties. Typically this is used by developers to own multiple properties at once and to sell the properties individually without triggering a loan default or any sort of repayment. Usually in a typical mortgage, you would have to, as soon as you sell the property, you would have to pay back that loan. Where in this sort of blanket mortgage, because it covers multiple properties, you're allowed to sell one property or buy a new one without having to repay the whole thing in full without triggering any sort of default whatsoever. The main benefit to the blanket mortgage is it just allows the buyer to have more cash on hand, typically, just because they now don't have to pay for the opening and closing of multiple mortgages, and obviously all of the lower fees associated with that as well. However, of course, with the blanket mortgage, because it is a more creative sort of way to do a mortgage, you're obviously going to have higher costs related to that mortgage itself. Meaning you might have slightly higher interest rates, but in general, the cost should be a little bit cheaper than getting many mortgages for all of these different types of properties that you may own. Okay, the last loan is called the wraparound mortgage. This mortgage is a little bit different. This is essentially where the seller is going to keep an existing mortgage on the property, and they will sell this property to the buyer, with the buyer having a junior mortgage opened up on the house, which essentially is to pay for the existing main mortgage on the property. So let me show you an example. Okay, so now we're going to look at an example of what does a wraparound mortgage actually look like. And so like I said, basically what we're doing is we're going to have a seller, we're going to have a buyer, but the seller is going to sell the property to the buyer without paying their existing mortgage. So for example, let's take a look. So we have, let's say we have John. John is our seller, right? So this is John over here. And let's say John wants to sell the property for, something like $500,000, right? So that's the listing price. However, John has an existing mortgage on the property, right? So existing mortgage on the property, and this is of $450,000. Okay, so John didn't pay jack, or he refinanced a few times, and he has $450,000 at the time of when he wants to sell the property, right? So now we have the buyer come in. So we have Mary come in. Mary's our buyer. Mary comes in and she's like, okay, I need financing for this property, right? Let's say Mary has no money of her own. She doesn't have anything saved up, right? So now what John can do is John can say, okay, Mary, how about instead of you going to a lender and you getting this $500K, right? Because usually you're going to get the full mortgage from the lender, or at least if you have some savings, you're going to get part of it, right? In this case, Mary has no savings, right? So her savings are $0, right? So Mary needs a loan. That's about the price of the actual property, right? $500K. What Mary can do now is she can go to John, and John might offer her a wraparound mortgage. So John says, you know what, Mary, I'm going to offer you this wraparound mortgage, and I'm going to offer you this for, let's say, something like $500,000. So so the purchase price of the property. However, now the way this works is a little bit interesting. When John sells the property, so just a few key points. When John sells the property, one, John will not pay off his existing mortgage, okay? So he's not gonna pay off his existing mortgage on the sale of the property. That's the first thing. It's not like a typical kind of where I sell it to you, I pay off my mortgage, you get a mortgage, and you buy the property. It doesn't work like this. So wraparound mortgage, the first point is John is not gonna pay off his existing mortgage. What happens is I'm gonna give, let's say I'm John, I'm gonna give Mary this wraparound mortgage, and she's gonna now make these monthly payments to me as I make my monthly payments to my lender, right? So here's what happens. Let's say, for example, my monthly payments are, let's say, $2,000. Every month I pay $2,000, John, right? Mary, her monthly payments under this wraparound mortgage, right? So keep this in mind. This is the wraparound mortgage. So I'll just put WA, wraparound mortgage. Her monthly payments, let's say, are something like $2,500. So that is based on what they agreed on, right? Now what happens is John goes and John says, okay, you know what, Mary, this is the terms. You're going to pay me $2,500 a month. And John is now going to use this $2,500 to pay off his monthly payments from his mortgage, but he's going to keep the profit for himself. And so now John is making money in two ways. Right? One is Mary gives him $2,500 every month. He pays off his lender $2,000 a month, but John gets to keep that $500 profit. So, you know, I'll put this over here. John, right? So number two, John makes $500 in profit every month, right? Also, John is gonna make profit. So John makes profit on the interest rate difference, okay? Between both loans. So between his existing loan and the wraparound mortgage he's giving to Mary, he's gonna make a difference on that as well. Because he's obviously, you know, if he's doing the monthly payments of $2,000 at, let's say, 6%, right? He's gonna give this payments to Mary at something like 7%. He's obviously gonna do higher. And so he's gonna make a difference on not only the listing price, right, which is these monthly payments, he's gonna make a profit there. He's also making a profit on the interest. And of course, he's getting these monthly payments, right? So number four, John is also getting monthly payments. Okay. So that is essentially what the wraparound mortgage looks like. Okay, so let's look at some of the risks now involved with this itself. So like we talked about in terms of benefits, right? John is making money, he's making profit, he's making monthly income, and the buyer gets an alternative way to get money, and you know, potentially it's a little bit faster or a little bit easier. It could be, right? So now if we look at the risks, so risk number one is if Mary, if Mary stops paying John, John still owes $2,000 every month to the bank, right? To whoever their lender is. So it doesn't matter if, you know, Mary is going to pay John that money every month. So John does take the risk of Mary defaulting. So that is a possibility. Okay. Okay. Now risk number two. This is basically if we have John's lender who comes in, and John's lender says, you know what, we're going to force a due on sale clause. A due on sale clause basically means John has to pay the full mortgage on the sale of the property. Meaning this mortgage wouldn't even really work because they're gonna have to pay all this money at once, which they might not have, right? John might not have this money. And obviously screws up the whole wraparound mortgage in general. Of course, they can still keep the wraparound mortgage in place, but it's no longer really considered a wraparound mortgage because if he pays off this existing mortgage, then it's not wrapping around anything. So technically or legally wise, they would have to revamp that contract or they would have to basically cancel this wraparound mortgage here. Okay. Now risk number three, which is actually risk for Sarah, is that if John stops paying their lender, right? So for whatever reason, maybe Mary stopped paying John and then he stopped paying, or maybe Mary's making her payments, but John just stopped paying the lender. If that happens, Mary runs the risk of losing their house. So she may lose her property simply because it's not actually Mary's property, right? Typically when you buy a property, yes, the bank owns it until you pay off the mortgage. Yes, it's used as collateral, right? But in this case, Now, Mary bought a property which still has John's existing mortgage, which means it's not even Mary's fault or in Mary's hands. Actually, she's kind of at the hands of John, whether he's making his payments in John's bank. So it's actually like Mary didn't go to her own lender and just paid that lender directly. She got a loan from John, John paying his lender, and now we have this chain of people that are responsible, and a lot more things can go wrong. Okay, so that's essentially what the wraparound mortgage looks like. Those are kind of the benefits, the risks. That's just an example. Hopefully that made sense. And that is loan number 3. So let's move on to some of the math. Okay, now let's look at one of the math questions that you might get, which is called the loan to value ratio. Now this ratio, I put the formula actually here, which is the loan balance of a property divided by the property value. Now this is a question that comes up quite often for a lot of people on the exam. So it's pretty simple, but you might just either be asked the formula or you might be asked to calculate it based on a question. And so for example, let's look at this example here. So John wants to buy a house that was appraised at $500,000, right? He's already made a down payment of $50K and has $100K of his own money. What is the loan to value ratio? Meaning, what is the ratio between the value of the property and the loan that we took on the property itself, right? So we know from this question, the value looks something like $500K. Now we look at the loan, well, John has $100K of his own money and they made a down payment of $50K, right? So first of all, how much loan does John actually need? So we go down here and we look, okay, well, loan needed is going to be the value, $500K, right? Minus the $50K down payment that we already paid out of our own money, and another $100K on top of that of John's own money as well. I mean, first of all, John needs a $350,000 loan, right? Because he doesn't have that money. We take that loan and now we divide it by the value of the property itself. And so the appraised value was $500K. And so super simple, we have a loan to value ratio of 0.7 or 70%. Meaning John is going to finance 70% of the value of the property with someone else's money, with a loan, right? All that means is the higher it is, the more riskier it is, right? So here's some tips that you need to remember for this. Number 1, if it's above 80%, it's very, very risky. That means you finance 80% of the value of the property with someone else's money, or you didn't have enough on your own. That's a lot of payments and that's a lot of debt to have. So lenders like to keep it under 80. More so, they like to keep it under 50, if we're being honest. Okay. Second is this kind of ratio, LTV, it's used to assess the lender's risk. So how likely is it that this person is going to default? Like I said, the higher loan amount you take against the value of the property, the more chances that you will default because it's more debt and it's more higher payments. Okay. And this is the main point that you want to remember, this last one here. This comes up on the exam all the time in multiple choice questions. Essentially, the higher loan amount you take, the higher your LTV, okay, and the higher interest rates you're going to get, okay? So for example, if I take this example, we did 350 divided by 500, and that gave us 0.7, right? Now, if I did, for example, so if I do this on the side, right, we do 350 divided by 500, right, 0.7. Now, if instead, let's say I take a higher loan amount, I do 400K, right? So 400,000 divided by 500,000. Now, my ratio goes up to 0.8. Super simple math, right? The higher loan amount, the more LTV, the higher your ratio, and the more interest rates you're going to get because it's more riskier, or you simply will be denied a mortgage. Okay? So keep that in mind. That is what the LTV ratio looks like, just based on this kind of simple example here. So just based on this thing here, I can actually move this up so you guys can see the whole thing. But we look at this thing here, and that is essentially what it looks like. Okay, so keep that in mind. It does come up on the exam. You do want to study it. Yeah, it's very, very useful to know. Okay, now math question number 2 is actually the NOI formula. So this formula will come up on your exam, very likely. So I'll make another video going in depth into all the examples and everything about it. For now, I just want to introduce the formula just so you get a gist of what it looks like. So 2 things you got to know. First is how to calculate NOI. NOI is our net operating income, and that is where we take our gross income, right? And we minus our operating expenses. Income minus expenses is NOI, net operating income. Now, when we take the net operating income, we put it into this formula, and it can give us market value of a property or of a business. Typically, this is used to assess business opportunities, meaning a capitalization rate, by the way, on the exam, they will always give it to you. You don't need to know how to calculate. But the cap rate, essentially, what it tells us is whether an investment is a worthy investment. How profitable is this investment likely to be? Typically, a higher cap rate is better, right? So higher cap rate usually means higher potential return of the property. However, on the exam, they're going to give it to you. So for example, let's say I get an income and I get expenses on the exam. I do the subtraction, I find the NOI, and then if I want to find the market value of that business or that property, I'm just going to do the NOI divided by the capitalization rate of that property itself. So this is the main formula that we use for the NOI question, and the reason it's called the NOI formula is because you can rearrange this. So I can do NOI equals, right? And I can just do, you rearrange the whole thing around, market value times capitalization rate, right? That is essentially the formula that we're looking at. It's the same thing. We just kind of rearrange this around, and now we can find an operating income. So on your exam, they will give you 2 out of 3 of these variables, and they'll ask you to rearrange it. So if you want a specific kind of video going in depth into this, give me comments. It may already be up by the time you're watching this, so maybe check out the channel and look at some of the other videos. But I will make one going in depth so you can see everything that you need to know for the exam. Okay, thank you so much for watching. That is it for today's video. Please leave a like or subscribe if it helped, and leave some comments if you like the sort of Excel type video that I've been doing recently. So please give me some feedback, and good luck on your exam. See you guys in the next one.